Hello everyone, welcome to the Profits meet. So I'm just waiting for a minute for participants to just log in, uh, some learning, and I will also give you some inputs on what is happening in a few sectors, which I want you to pay some close attention to. So let us begin the session right now in terms of understanding the overall aspects of the current situation in the markets. So just type yes if you can see my slide. Just type yes if you can see the slide which we're sharing here. Yes, wonderful. So yes, we all had seen that the markets have risen to an all-time high around 58,000 levels in terms of Sensex, and in terms of Nifty, the valuations are around 17,000. We have crossed 17,000 for the first time ever. So how many of you are feeling that the market is high currently? Market is high currently. How many of you got this feeling that the market is high currently? Type high if you feel that the market is high. Yeah, some of you are thinking, yes, market is high. But what I'm going to do, that is like decode what exactly is causing this rally in the market, or why market is behaving in such a way. So let's look at these factors. Why market is behaving in such a fashion. So if you are looking at the main reason why this has happened, is that you are able to find that the GDP numbers, if you're able to look at this, the GDP numbers, the GDP number, if you're looking at 2020, last year, the first quarter was a washout. So the GDP has been taken a hit of, it actually dropped to minus 24%. That was the GDP in terms of numbers. But what we are seeing here is that this current year, we are finding a recovery happening. So what we call it in economics, we call this as a V-shaped recovery. Can you see this like V-shaped? So this is a V-shaped recovery, but you have to understand this one is representing only the companies in the Nifty. And the companies in the Nifty, you will find that it is not a right representation of the entire economy. So what we are finding here is like the GDP in terms of the numbers, we are able to find that the GDP recovery is there. And the second thing what I wanted to show you is that the Nifty 50 companies, if you're able to see that, the 50 companies which had seen a dip in terms of their sales from a lower base, the recovery has been almost like 50%. The sales growth in this quarter, when you compare this, we have seen this up by 50%. So that is one positive sentiment. We are seeing the earnings coming back in terms of one, the sales, and second, the profitability. Can you all see the profitability of the Nifty companies? It is up by more than 100%. The main reason was that this one, there's a huge drop here. So this is actually having a big jump. This is the cause for a huge rise, is because that if you compare this with the last year, the jump is almost 100%. So that is one of the reasons why you are seeing a growth in terms of the profitability. And if you look at further reasons, what we are seeing is like, if you look at the P ratio of the market, the pink color line, I want you to track the pink color line. If you look at the pink color line, this is the P ratio. And the blue color line represents the Nifty. So what is happening? The P ratio, which was close to around 40 levels, in the month of the first quarter, I would say like this was somewhere in the month of Jan, Feb, March, what we had seen is that there was a change in terms of how do we calculate the earnings per share. So what it essentially meant was that earnings per share, which was earlier used to be calculated in terms of a standalone basis, we had seen that a shift happening from a standalone basis to a consolidated basis. So what it meant was that because the consolidation earnings were taken place, the earnings had a one-time impact. It became a little higher, the earnings of the company. So what it meant was that P had come down. How many of you are getting this point? Type yes if you got this. Because the earnings per share shifted from the calculation from a standalone basis to a consolidated basis, we had seen that this meant that the P instantly had come down here. And today we are around 26 times earnings. If you look at what is the earnings per share, the P ratio is almost similar to what we had seen in the major part of 2019. So yes, this is the current P ratio of the market. Actually, the earnings per P ratio has come down from what it used to be in the month of Jan-Feb. That was the time when the P ratio was high because the earnings per share were under the old method. Under the new method, what we are able to see is that the earnings per share. So I want you to look at this one where the blue color line, this blue color line represents the earnings per share in terms of the Nifty. So what you are able to see essentially is that this one, the earnings per share, because one, we are seeing the consolidated method being used. Second, also we are also able to see that in terms of the sectors which are performing, most of the companies, especially the companies in the Nifty, aren't much affected by the COVID situation. For example, if you look at, can anyone tell me which was one or two sectors which were very badly impacted by the COVID situation? Which are the sectors which got heavily impacted by the situation? Yeah, we had tourism, hospitality, airlines. They were the sectors which got heavily hit. But if you look at these sectors, they are not essentially the sectors which are part of the Nifty. Because what happens, we do not find one tourism stock which is representing in the Nifty. So what it means that there are some companies, like for example, if you look at Infosys or Wipro, most of the IT companies, they did not have a big impact because of COVID. Work continued as normal. And in fact, they have also grown in this period. So essentially what we are meaning is like those companies in the Nifty relatively did not have a big impact compared to stocks which were in other sectors, which were not much represented in the Nifty. So you need to understand this clearly, that Nifty is not representing the economy. Because Nifty is, the construction of the Nifty is like the largest 50 companies in terms of different sectors. And it is overweight on few select sectors. See, 5 sectors dominate the market. And almost these 5 sectors are contributing almost more than 70% of the Nifty. So this is a little bit a skewed index. So that is one reason why you're finding that the earnings per share is now on the higher side, and the current earnings per share is around 652. So if you look at the current value, P value of the Nifty, it is around 26 times earnings. So if you're looking at which sectors have been doing well in terms of the EBITDA growth, like year on year, you're finding that some sectors have been extremely well. This will give you an indication of what is the real strength in terms of where the action is happening. So if you're looking at banking, financial services, over the last 1 year, they are having, if you look at, there is not much of a big growth because they are still, if you look at the situation, the NPA levels are there because one, we had a pandemic last year and a lot of people, they had to look at delaying their EMI payments, everything. So the banking and financial services is actually taking a hit. If you're looking at where this growth is coming, The growth is primarily coming from one, you're finding metals doing extremely well, you're finding auto, which is doing better, you're finding infrastructure, capital goods. Those are the ones which are doing well. But traditional sectors like FMCG, you're finding pharma, all showing only a moderate growth. So this is where you need to look at where the momentum is happening. So what you're able to find is that few sectors are doing well, but the major sectors, if you're looking at banking has been doing fairly, I would say, like the same levels because they are still stressed by a lot of NPA issues, a lot of provisioning which has happened. And if you're looking at other sectors, infrastructure, metals, they have been the ones which have been leading in this rally as of now. So if you are asking me, like the current valuations is 652 as of the first quarter. We have only closed the first quarter. And if we are able to find out what will be the valuations for in terms of the uh, current financial, that is FY 21-22, according to projections, like these are analyst projections. And remember, whenever we are saying taking these projections, we have to take it with a pinch of salt. So I'm just giving you a fair indication about this. Say if the earnings per share touches around 700 levels, and if you are giving a P estimate of 25 times, Nifty could be around 17,500. That could be the level where Nifty can be trading at current valuations. And if the earnings from 650 levels, if the earnings growth continues to happen, like the companies are doing well, and if their growth is there from 650 levels, we are able to close this financial year at around levels of 750. Then if you give a valuation of 25 times, Nifty can be around 18,750 levels. So this is what is the estimates what we are able to see. And remember, whenever you are able to see the estimates are based on what is the current scenario. In case something unexpected comes up, these estimates can go for a toss. And also what happens currently, valuation is 25 times. So in case there is a change in the sentiments or something uh, un, unexpected happens, this sentiments can also change. Like, so from a PE of 25, it can also drop to 20. So you also can calculate a worst case scenario. Like if PE is around 20, then Nifty could be around 14,000 levels. So we need to understand, okay, what will be the probable range? I'm just giving an idea, but remember that this is just an indication because most institutional investors, they take a call about how they look at it based on these factors. Type yes if you got what exactly the market valuations and you're able to get better idea about this. Just type yes in the comment box if you can get what exactly are valuations currently. And though the market has gone up, Nifty valuations, I would say, are slightly expensive, but it is not too expensive as many think they are. Because markets have gone up because earnings per share, the methodology has changed. That is one. And second, what we are able to see is that people are anticipating that the recovery will continue because of the anticipation, and we are seeing some positive sentiments in terms of the Q1. If that continues, we might see that this levels might sustain. So this is my opinion in terms of the valuations in the market. Let's look at some other factors also. What exactly is there in terms of what is happening in the overall markets? So this is one particular image which I got it in terms of my WhatsApp about few weeks back, couple of weeks back. This image was there. So what do you observe from this image? This is a person who's riding an auto rickshaw. He's riding. This is an auto rickshaw driver who's in the streets of Mumbai. So what can you observe from this one? Let's see who gets it right. Ajit says he's observing the chart. Yabina gets it right. He's looking at stocks market. Venkat Rajan says awareness is increased to learn additional. Okay. So the key thing what we are happening is that one thing you can find is that more and more people are entering the market. So one big thing is that this became very popular. It was shared in the social media. It's like we can find people even in the grassroots level. Like we are finding people coming into stock market in large numbers. So that is one alarming trend which is happening. Like it is not right or wrong. Like there is no one to deny an entry to the stock market. But what happens is like when masses come into the stock market, it sometimes drives the prices irrational. So what happens is like when large amount of people come into the market, first time investors come into the market, they come in with fresh amount of money. And today what is driving? What is driving the liquidity in the stock market? What is driving the liquidity? Because if we can get this point, you will understand why markets are going. What is driving the liquidity? What factor is driving the liquidity? Raghu says post-COVID recovery. That is one point. Yes, that is if you are looking at some long-term money, that is yes. Girish is right. Girish is right. It is the low interest rates in the banks, which is actually fueling this. How many of you agree that the low interest rates is one which is fueling this rise? So what it means is that, see, few years back, people were getting around 8% in an FD, 9% in an FD. But today, what it means is that today I am there in the I'm investing in a fixed deposit. I don't even get 6%. Today the rates are below 6%. And if you are in a 30% tax bracket, what it means is like at the end of the day, you're getting around 4.2%, which you really think, because the market also has a recency bias. What is a recency bias? Recency bias is that you're looking at the last, say, 1 year's performance or the last 15 months performance from the lows. And from the lows, markets have been going up. Almost every month, the market has been going up. So because of the recency bias, and you're able to remember that markets have been going up from 25,000 levels in terms of the fall in March 2020. And you see that I'm investing 1 year and getting 4%, whereas if I can find a good stock and if it goes up, I can make this 4-5% in 1 month. So what it means is that investors, especially those first-time investors who haven't seen a downside in the market, they are getting more and more aggressive in the market. How many of you have seen this? First-time investors who haven't seen a market correction, they feel that market is a great opportunity. They put in some money. They find that the prices are going up, and once they find success, they are putting in more amount of money into the market. So this is something which, if you are an experienced investor, you have to understand that when this situation happens, markets start to behave irrationally, because what happens is that you might be holding a good stock, but the good stock may not go up. But there could be a very weak stock or a stock without having much of fundamentals. Suddenly that thrives or it goes up by 100%. What happens is that we get a feeling like, let me also try. So this is a very dangerous situation in the market where you should stick to fundamentals and avoid going behind some stocks which are just going up based on the price rather than based on the right fundamentals. Because this is a time when you need to make sure that most of the mistakes, if you ask me where do people make mistakes in a bear market are not very painful. If you look at it, this is the market movement. Mistakes which are made at the peak of the market, like whenever you're seeing the market going up and at the peak of the market, like in this situation, like at in this situation, those mistakes are very painful. Why? Because especially in inferior stocks or stocks which are having poor quality, they can erode a lot of capital. So this is a situation where we are getting into a situation where some of the stocks which are very weak, they are not having a strong earning power. They are actually driving, they are actually leading the market. So what you need to be is like, be a little cautious. Do not go just based on the price. Always look at the fundamentals. Look at what is the earnings the company is making. Look at, see, we have given you the framework of the growth investing criteria, also the value investing criteria. You need to see whether a stock which you're selecting is matching those. And if it doesn't match those, then you need to find out, are you paying too much? Because when a weak company goes up and if investors exit in mass numbers, the stock can have a vertical fall. Because that is the biggest risk in the market now, that do not get trapped because the market run up. Always stay with the quality companies. That is the one which you need to be, because the biggest risk right now is that everything is going up in the market. And one sentiment you can find out is like, what is the level of oversubscription in an IPO? And if you look at the month of August, I would say like August had a huge number of IPOs. Some of the IPOs had even 100 times subscription. And generally that is one indicator that the markets are having a lot of interest, especially among retail people. So this is one time for you to be a bit cautious in the market. So how many of you learning something? Type yes if you found some input so far, some valuable input so far. Type yes in the comment box if you got some good input so far. Okay. So today I thought like I came across one book. This book is called 100 to 1. This is a book written by an author called Thomas Phelps. So this book is all about how to find some investments like stocks, investments, which can create 100 times returns. Like it is like you're finding 100 baggers in the stock market. So I thought I'll just share this book. I'll also share the link of where you can find it. This book I only have the PDF copy. I'm not having the hard copy of this book. So let me share some inputs from this book. So this is a book by Thomas Phelps. So yes, I'll share this. So this is the name of it. 100 to 1. So this book is basically about what exactly makes 100 baggers in the stock market. 100 baggers are those investments which go up 100 times. 100 times in the stock market. So let me share some key inputs so that let's look at what exactly is this. So one of the things is like, see, 100 bagger is, see, if you get 1 or 200 baggers in your life, then you are financially free. I can tell you that because if you are investing 1 lakh, 100 bagger means your 1 lakh becomes 1 crore. So first one has to look at, yes, this is a possibility. Even to have that belief itself is sometimes, how do I even achieve of getting such a huge return? How many of you are finding that this belief itself, finding one investment which grows 100 times, how many of you are having that, even that belief itself is so hard for you? Type me if you're finding that even that belief that my investment will grow 100 times, it is very tough even to imagine that. That happens sometimes, because what happens is like, when we are constantly looking at things, we get more of short-term orientation. But when we start to relate, see, the mind works when we start to relate to things and we find more and more evidences supporting it. So what you need to do is like, you need to cut off from the noise, because television and the media is all short-term noise, and you have to look at the real voice in terms of what is the real reality, in terms of how do you find people, or how do you find evidences where you can find such huge returns in the market. So let's look at this, some of the key inputs for them. The first learning is that the author says is that fortunes are made by buying right and holding on. Always remember, it's like you need to have a waiting period. Sometimes it might be a decade, sometimes a little more than that. But what you need to do is like you have to buy and select the company and sit on that investment. It's like you're not looking at getting in, getting out, but you identify a right investment and sit on it. And the problem most people do is that they exit it. They are too impatient to hold on to the investment, or they exit it at the wrong time. See, sometimes what happens is like we are mentally looking at anchored on the prices. So if you're too much fixated on the prices, that means like you are too much attached to your purchase price. That is a big barrier. You need to overcome the barrier, because when you stick to a price, you are not valuing the company. You're only valuing, okay, what is my purchase price? From that, you should shift to the concept of forgetting the purchase price and only looking at the current levels. Like, let us take a stock at the current levels. What is the value? And from now on, what is the potential for stock? Always like the moment you disassociate from the purchase price, that is when you start to become an investor. Because if you're too much stuck to the purchase price, what happens is like you'll always think, okay, I'm making this profit, this is my loss, and you will not understand what is the real value. How many of you are getting this point? You need to look at understanding that you need to disassociate from the purchase price and make sure that you're always valuing the company based on the potential of the company. So this is the first thing. What is the second one? Well, the second important learning from the book I could share is that the three things what the author says is that the vision to see them, the courage, and the patience. And the author says that the rarest of the three qualities is the patience. The three qualities: vision to see the growth of the company, courage to buy them at the right time, and the patience to hold. So if you look at it, for example, I would say like I was here listening to Rakesh Chunjunwala's method in terms of understanding about the way he looked at picking up Titan. And one of the members in Rakesh Chunjunwala's team was helping him at the share, and he was sharing in one interview that Rakesh Chunjunwala had more vision in the company than the promoters of the company at that point had. Because the promoters did not actually anticipate such a huge growth. But the moment Rakesh Chunjunwala understood in terms of the gold business, and he got that this business, when Tanishq was expanding in a huge way, he was able to see that this had an ability to gain a market share from the unorganized player. And this one thing made him so convinced about the stock that he bought a very big quantity in 2004, 2005. Very, very long back, when not many people knew about Titan. And that was one, he had the vision to see that this market will be so huge, and not many people had that vision at that point of time. Titan was not much heard. People knew the business, but they did not anticipate this to be so much. And when you look at the courage again is something which is very, very important, because what happens, courage, sometimes you will not be able to get it in the market in all times. So we were discussing about the courage. I'll just share one incident. So this is about, I will just share the screen so that you get this much better. So this happened in, let me share this one. So this is about last year. This is about a stock, Bajaj Finance, one of the great financials in terms of companies. So in the month of February, can you see that Bajaj Finance was around 4,800, almost 5,000 levels. But what happened was that from 5,000, almost close to 5,000 levels, the stock dipped to 1,900 levels in the month of May. 1,900 levels in the month of May. And people across the board, they were very, very pessimistic about NBFCs. But you have to understand that Bajaj Finance was one of the better run companies. And if you look at the P ratio, the P ratio of Bajaj Finance, the stock was trading at almost like 40 times P ratio for a major part of the time. And if you look at the month of May 2020, the P dipped to 20 levels. One of the best run companies in India at a PE of 20, you are able to buy in the month of May last year. And if you could enter the stock, because that was one quarter where everything was challenging for company. But can you see that what is the upside? From 1,900 level, the stock almost has gone up to 4 times from those levels. I would say like it was a great opportunity because at 1,900 levels, you are buying the best NBFC, one of the best companies in India, at 20 times earnings, which was not available for a long time. Can you see in the last 5 years, this was the time of demonetization. Even we were able to buy the stock at a level which was even cheaper than the demonetization levels. So this was a great opportunity. To buy a good company, you need to have a courage to buy it. Because when the price is low, we think it'll go for low further. You need to know, yes, I am entering a stock. I am putting in some money. I'm betting it out. And the third most important thing is having the patience. Patience is one of the rarest qualities which people say. And this is something which I have seen, like patience is something like you can have the best talking cooking ability, you can get everything right in terms of your inputs, but if you lack patience, you will not make big money. Because big money is made on sitting on the stock, waiting, and riding the stock on the way up. How many of you are learning? Very, very important qualities to have. One, have the vision. Second, when you get an opportunity, have the courage to put in good amount of money. And third, patience to ride the stock on the way up. The third thing which the author says is that the greatest mistake made by the public is paying attention to prices instead of the values. So as I told you, do not look at the price. Price is the trading factor. What you see in the screen, the price is that. But always look at what is the value in the stock. Today, if I'm buying it, what is the value which I'm getting? What am I buying in return for paying this price? And if the value, if I can justify, you can still look at buying a stock. Say, sometimes you would have bought a stock, like for example, we discussed ICICI Securities multiple times last year. We discussed the stock was around 350 levels. We discussed the stock when the stock was around 600 levels, because what happened? 350 and 400 levels, the stock, despite a 50% run up, you are still trading at a reasonable valuation. So what you need to do is like understand the price might rise, the company might be still trading at the same value. Valuation wise, always look at the valuations. What is that which is driving this? Okay, let's look at another learning. This is another learning which is very interesting. So in this book, there is also this learning which says that many of the investors, thousands of investors, would have owned these stocks at some point of time, sometime or the other, over the last period of time. But many investors, what happens is that they enter the stock, they will also exit at a small profit. And very few will hold it till it has increased its value. So it's like one of the things which is very tough is to hold on to a stock. Because a lot of times people look at, as I told you, they look at the purchase price, they make all the decisions based on their purchase price. They look at taking a decision, like the decision to sell or buy is based on their purchase price. And also remember stocks being the most liquid thing. Because today the biggest challenge for any investor is this. How many of you agree this? The biggest challenge for any investor is the overdose of information. Today what is happening, the news what you get is so much fast and rapid. The moment you are in a WhatsApp group, you are seeing any message, the moment what is happening is that you are reacting to the message. So what is happening is that when you are having constant news coming in, and today what is happening, technology is so advanced, you have apps, you can log into your account in an app, and just with a click of a button, instantly your order is sold. You can be in an office, you can be in a meeting, and still you can do a sale without in just 30 seconds. The ease of transactions, the low cost of transactions has made investing very, very tough. Because what happens when your decision making is so easy and when we are so reactive to news, even a rumor or even a false information or even some random news, that can cause a big impact. Because a lot of times, if you look at what happened, say 15 years back, even to get an internet connection or to call up your broker, you need to make sure that your broker's line was available. So what you had was like, you used to call up your broker, the broker will then maybe give you some inputs on the stock. So what happens, there was a time delay from the moment you decided to sell a stock to the actual sale happened. Because earlier, the news itself used to come even one day later. What happened today, you saw it in the television news channel, maybe at the night around 9 o'clock news or 10 o'clock news, or it came to your home in the newspaper the next day. But today, what is happening with so much of technology, it is also having one of the disadvantages. How many of you are getting this point? That technology itself it is sometimes putting us on the back foot because I'm reacting. I'm reacting to every news coming in. And the more amount of data I'm feeding in, and if it is not relevant to you, you will be finding that you will be making many decisions which are not in. So feed very less information. Irrelevant information you can just avoid because it is going to be very, very injurious to your wealth creation. So this is one important fact. And the next important learning, which the author says, is that focus on earnings. So what you do is like you look at these three things. Company should have a above average ROC, above average profit margin, above average sales growth, and it should be looking at new markets or expanding markets because that is when the earnings grow. When I'm having these factors, like I'm having a reasonable ROC, when I'm having in terms of my profit margins and in terms of my sales, that is when I'm going to find multi-baggers happen. So let's look at some aspects of this. What happens is like generally when you find companies with decent ROC not lose much money in stock. If you look at any business, a good ROC, businesses with decent ROC, you will never lose money in the long. So I'll just tell you what we can do is like I'll just show you here. So I'll just show you how we can look at this one. So I'm just sharing on this one, looking at an ROC. ROC, I've given this query. So ROC greater than 45 and market cap more than 3,000 crores. Let's give it at 25. Okay. So you're having 81 companies which have done extremely well in the terms of good ROC. So always you'll find that whenever you're finding a decent ROC, you are making sure that the company is not ending up destroying a lot of their capital, and they are efficiently run. The only challenge with this ROC number is like we do not take the stock price. So if your entry level PE is very high, sometimes you might be ending up in a situation where you buy it at a very high PE and the stock doesn't perform for a long time. So your entry level PE also matters. And second thing is like you have to understand that cyclical stocks do not come under this, because cyclicals you need to understand which part we are buying, which is the entry point for us cyclicals. Because cyclicals, remember, it's not a buy and hold. Cyclicals you will make money, but you have to buy and exit. Yeah. So we are discussing on the book 100 to 1, 100 to 1. The two reasons why people are struggling or people do not get this is that one, they do not try. They frankly do not try this. And second thing is like they do not hold on. First is like, okay, I should have the ability to look at even think that I can hold 100 back. I have the ability to look at least finding if I find a great stock, not to sell it or not to liquidate it too easily. Because another big mistake what we do is like we look at profit booking, and it's a very wrong thing that profit booking is as a strategy. Remember, profit booking as a strategy, it is for people who are trading, they are fine, but for an investor, very wrong to do profit booking. Profit booking, you should not do it unless the company's fundamentals have changed, or it means that the profitability is no longer there. The underlying growth factor is completely reversed. So until then, don't do any profit. Sometimes if the growth slows down and if the sector is not having that much of a growth opportunity, then you can shift. But be very, very clear, just for the sake of maybe thinking that the price will come down, I'm going to book profit, it's too much of it. Because what it means is that you will sell a good quality stock, and moment we sell it, very rarely people have the ability to buy back the same stock. How many of you agree? The moment you sell a stock, let us take you buy a stock at 100, you sell it at 300, very, very rarely you will buy it again at 400. How many of you are agreeing to this point? I buy it 100, I sell it 300, now the stock is 400. To buy at 400 is not easy. But some investors, real institutional investors, they know that if they can see that the stock is having the potential, they will be buying it. But retail investors, I would say that once we sell it at 300, we will be not open to purchase until it comes less than 300, because our mind is like that. We are tuned to be only looking at the price. But when you see the real value, the price jumps, maybe it is okay to buy. And remember, it is not one purchase. It is not one purchase alone. You will not buy your entire quantity at one shot, but you will be keeping on buying it. You might buy a stock at 80, you can buy it at 100. Because I remember when I started with the Page Industries, I started with 2,500. Then we kept on going up. We kept on averaging it. We kept on improving it in terms of like over a period of time, over the next 3 years. As long as the stock earnings were going up, we increased it. Our first purchase was 2,500, but the last purchase was almost like around 11,000, 12,000. So almost 5 times more than the first purchase. So it is not necessarily like you are buying a stock only when it is closer to the your first purchase. Your subsequent purchases might be even at a higher levels, much more than your original first purchase price. Always be open to that fact that I can add to a good stock at a price which is much higher than my original purchase price. So this is one important factor. And the final quality which I think the author shares is that it requires an extraordinary tenacity, the will to hold on to make 100 back. So I'll see if I can share this book to you, because uh, I'm not able to get the physical copy, but let me see if I can share the PDF. So these are some of the factors, or I would say like some of the key learning from the book 100 to 1. I would always suggest like every month you look at least reading 1 to 2 books on investing, because what happens is like the more you are able to develop your belief, the more you'll become clear on your journey as an investor. Because investor journey, I would say like it's a journey which is, how many of you agree that this journey is a pretty lonely journey? You're going to find that very few people are, you will find, interested in what you do. It's not as exciting like going to a movie or something. Very few people will be in this wavelength first to even understand okay what you're doing. Most of your friends will be, some of them will be looking at making money short term. They will be looking at doing all sort of things where it is all short term oriented, whereas you are doing something which is all long term focus. Your focus is on long term. Your focus is on making money, that it is a one time process of wealth creation. So sometimes this journey is lonely. What you need to do is like you need to build that courage that yes, I will be able to do it. I'll be able to create a multi-bagger, and it starts small. Sometimes once your stock doubles, then it triples, then you slowly start to believe that yes, I can pick up stocks which will do well. So I'm just focusing on some trends right now. I'll just share some trends which I thought will be useful for you. The trends in terms of what is happening in terms of overall in the market. There are few things which are moving in the market which you need to be careful of or be watching out for this. So right now what we are able to see is that the freight earnings are at a 13-year high. So what you're essentially seeing is that from the low of 2020, this one, the shipping charges, the freight charges have gone up by 5x. 5 times is the jump in the freight charges. So this means that if I want to ship some items, it's going to cost me 5 times more. And all this adds to the inflation part. Are you getting it? It's like if I'm moving goods, I'm exporting or I'm importing something, my cost of this is the freight charges. Cost of shipping from one place to another is in the freight. So when this goes up, my production cost goes up. So this is one thing. So if you are in a shipping industry, this is a good time. If you are the shipping industry, they are having a good time. But if you are importing, this will be a lot of things which will be challenging right now. So yes, this was something like if you're looking at 2007-8. Yes, this is lesser than, because that times they were unprecedented times when global economy was in a big rapid growth. 2001, 2008, we had seen a huge expansion happening, and right now we are almost nearing to that 2008 highs. The second thing what you are able to see is that steel again, what we are seeing is like touched a high in May. It had corrected a little bit. Again, steel prices are moving up, inching upwards. So this is again is it's a good for if you're a steel producer, but if you're bad in terms of if you're consumption in steel. And secondly, what you're also able to find is that aluminum prices have hit almost a 10-year high. It's almost like $2,900 per ton. It's almost a huge jump when we are seeing over the last year or so. So I think on the last week we had seen 3% close, 3% upward move, which means that globally the cost of production will be increasing by almost like $500 billion. Just because of 3% move will mean that the cost of production globally is going to increase by around $500 billion. So these are some of the trends. Like what we are seeing is that commodities are finding a movement. Commodities are not correcting currently. So what it means is that those businesses which are producing these commodities, they are in for good times. They are going quite strong, and you are going to find a situation that businesses which are using these commodities, or they are the raw materials, they are using these commodities as the raw materials, they will be having challenging times. So what we have seen is like it's a different situation. Like earlier we had seen FMCG, those stocks doing extremely well. The last decade was driven by consumption. Now what we are seeing is that consumption might be having a challenge. The consumption theme may be having a challenge. Because what is happening, consumption theme, uh, when your input costs are rising, and also you're able to see that because of the COVID, people's income levels are dropping, they are going to face a challenge in terms of how their uh, expenses are going to be managed and how much they are going to save. So people are a little bit cautious in terms of spending. So consumption is going to be challenging right now. So, but if you're looking at commodities, they are doing quite well. So these are some of the inputs which I wanted to share. And so conclusion right now, commodity producers, watch out for these. We are still having steam. Commodity consumers, like that, they will start to feel the pinch if this trend is continuing. Because remember, it is not very easy to add capacity in commodities, because to set up a steel plant, it's not so easy. It takes years to set up any commodity to increase. It's like you can't just increase the supply, because what is happening now globally, when the prices are rising, people who are able to have a lot of cash, they can buy this commodity. They will start to hoard this commodity. So we need to see how these trends play out. And another important factor is like what is going to happen in the terms of the interest rates in the US right now. The interest rates are, we are expecting this to be at the lower levels, and as long as they are in the lower levels, we can see this rally gaining momentum. So this is my view in terms of the markets at the current situation. One needs to be a little cautious, because whenever corrections are happening in bull market, corrections will be very, very fast. It's like you can't get in, get out. That sort of a strategy doesn't really work. You need to be looking at holding on to the companies where you're having a good conviction. And any questions, let us see if we can take it up right now. Okay, so there is one question. Anand Subramaniam is asking, is there a place to get these charts? Yes, there, you can go to LME, London Metal Exchange. You can go to Kipco Metals. These are some of the popular sites when you can check out. Let me see if I can share those things. So you'll be able to find such inputs, like any specific inputs, you'll be able to get this here. So one, go to this site where you'll be able to find trends about what is happening in the metals. Like, so this is one thing you will be able to find. And they're asking about earnings line versus share price. Okay, so in screener, what you could do is like, I'll just show you. So this is a interesting thing. So in the book One Up on the Wall Street, Peter Lynch asks us to look at this earnings and the share price. So let's look at, I'll be sharing this one. Let me share it. So this one will be a good indicator. So this one, so in the screener, what you do is like you will get this chart, price chart. Go, you shift this to P ratio. What you're able to see here is that this light blue line, right? This light blue, which is looking like a skyscraper, this is the earnings per share for that particular quarter. So if you're looking at November 2017, the last trailing earnings is 268. So this keeps changing every quarter. So you'll be able to find the earnings per share over a period of, like, every year you'll have this updated 4 times. And the dark blue line, which you're able to see here, that represents the P ratio, the corresponding P ratio of the company. So this one, most people will look at the price chart, but what you can do is, like, from the price shift to the P ratio, you'll find completely different understanding. You know the real value of the company when you start to study the P ratio, P ratios and the earnings per share. Because as long as the earnings are there, the price will continue. The price growth will be. So there is another question. So Nifty PE, you can go to BSC, sorry, NSE India, you will be able to find it. See, let me share on this one. Let me share on this one. So this one, but remember, like, Nifty P ratio, all these are tools which institutional investors generally use. For a retail investor, we should not be getting too much complicated into, or too much focused on what is the Nifty valuation. Because as a retail investor, I would say, like, the key focus, if you are able to focus on valuation of individual stocks, that is more than sufficient. Let me see if I can get it. Yeah. So this is the one where you are able to get this one, and for a Nifty P ratio. So just go to this one, Nifty. You have to go to products, equities, indices, historical data, P ratio. So here you have to give this one the date. You'll be able to get this P ratio for this Nifty. Can you see that the P ratio is 26 points? This is the one you can get this one. So actually, as the results are coming in, the recent quarter P gets updated. So the P, if it is higher, it's actually, despite the market going up, the P is coming down. So this is how you will be able to track this here data here. So Kamlesh is asking, how do you look at textile and sugar as a sector? So Kamlesh, yes, sugar has been, yes, the news of ethanol story has been driving up the sugar prices. But yes, remember that cyclicals, they will be moving very quick span of time. And also when there are a lot of attention, like when you see this ethanol story coming out, like a lot of media attention is given, sugar has been lying low for the last almost 2 months. But we have to really keep a watch on what is the factors which are driving in the prices, because last year Brazil had a lot of issues in terms of low production. So we have to see what is the trend underlying and how these factors play out. So Ajit is asking, can you touch on the price to book and PE in screener? So price to book is a ratio which we generally do not use much these days, because what is happening in the price to book, remember, price to book is something where that used to be relevant when you are tracking companies which are in the old economy. But today, if you're looking at new economy stocks, you're not finding your technology or your IP is more valuable, and you are not able to see this value in the balance sheet. For example, if you're having a very good technology, like for example, if for example Zomato is there, they are having a good platform, but you are not able to see that in terms of the book value. So what you need to do is understand is that price to book is losing its relevance. You cannot use the same way what it used to be relevant maybe about 2 to 3 decades ago. What you have to do is like look at factors like P ratio is one, profit growth rate is one thing. Look at revisiting the 6 parameters which we told. That is more than sufficient if you're looking at a non-cyclical business. The another important factor is to find out what is the strength in the business model. How strong a company is, in terms of what is their strength of their business model, what is their competitive advantage when they have with their other competitors, peer group companies. So, are they having the market share? Are they dominating the market? Understanding the sector or understanding the business model, how strong a player is, that is very relevant in terms of finding out what is the strength of the business. And usually remember, the top 2 or 3 players make the most amount of money. Beyond that, you will find very limited. Unless they are very unique players, you will not find it, them to be surviving in the long. So, Kamlesh, what are the sectors which we focus for the down? So, currently, commodities are one which is quite interesting. Infrastructure also is something which you can look at. So, those are the points. And Rajkumar is asking any pointers to check before starting an SIP. SIP, you need to really check out what is your financial code, because there are totally around 40 different, 45 different mutual fund companies now, and you need to be very, very selective on which goal you are investing and then pick up a plan which was suiting you. Vijay Murugan is asking exit strategy for value and growth with the example at this point. What ratios should we see? Okay, I'll just explain this one. Maybe some of you would get this. Let me share up this one because it's relevant. So let's look at this. So I'm just sharing on this factor. So if you are looking at this one, Asian Paints is there. Asian Paints is one stock. So I'll be sharing on this factor. See, if you're looking at Asian Paints, last 10-year growth, the profit growth is been only around 14%. And the 10-year stock price growth is 27%. But if you're looking at why it has grown, you have to look at the ratio that if you look at the P ratios, in the last 10 years, the P has really expanded. Can you see this one? P was at one point of time, the stock used to trade at a 17 P, which was less than 20 times earnings. And the stock was trading at 30 times. Can you see the P expansion taking place? P is slowly expanding from 30, 40 levels. It has reached 50 levels. Today, the P is around 90 levels. For a stock to trade at 90 P, the growth is only 15%. Is it justifiable? Is the question. How many of you are agreeing that a 90 P for a stock, which is only growing at around 15%, long-term growing earnings is only 15%. Remember, this TTM of 54 is an exaggerated number because it's coming from a lower base of this one. But if you look at this one, 2019, 20, the profit growth is there, but are you able to see that this is way beyond than what we are able to see at current level? So I would say like this is one thing. Okay. So I'm just sharing it once more. So I was just mentioning about Asian Paints. What we are seeing is that the key thing, if you look at the last 10 years, is that the PE expansion has grown over a period of time. Stock trading at 20 times earnings has now the major driver the last 10 years has been PE has expanded to almost 90 times. From now on, if you are able to justify this 90 times P ratio, I would say that 15 times growth will be not sufficient. So in my expectation, the P will come down over a period of time. Maybe in the next 3 years, 5 years, I don't know. But from now on, I don't see the stock going up multifold from current levels. So this is how you look at the total valuation right now and whether the P is justified. How many of you are getting it? Like this is one based on the parameters which I shared in terms of valuations, in terms of what is the current valuation and how it is justified. So I'll also share one more thing. So let's look at one more stock which can be. So if you look at the stock, Avenue Supermart. Avenue Supermart, it's around 255 lakh crore, it's having a P of 222. Stock is around 4,000, 3,950. But remember the valuations what you're playing is very high. The stock is doing extremely well because the promoters are holding 75%, FIs are holding 10%. So this means 85%. Domestic institutions are holding 6%. The public is only holding 8%. And you're able to see that public shareholding another 2% is here. So very, very thinly floating stock is available. So when only 6% of the stock out of the total 100%, 6% of the stock is only being traded. Rest of all the stock is not traded. So what happens is like you also need to be aware that when a situation arises, when the stock is going up and there is very thinly traded shares, the stock will continue to go up because the number of shares which are traded are very less. Here it is only 6%. So in situations like this also you'll find that the P ratios will be extremely high. Another reason what we are looking at is that so Southern is asking real estate market is growing, why not Asian Paints? Asian Paints, yes, the growth is there, but what we are seeing is that 90 times P ratio. Remember the P has expanded from 20 times to almost like 90 times. So from here, a stock is a function of both. A stock price is a function of earnings growth, which is here, and the P growth. Earnings growth is only 14% here. So the earnings growth will be there, but from now on, how did the stock give you 27% return? Is because the balance came from the PE expansion. From now on, PE expansion will not be there much. It will only be the earnings growth. So we discussed on this front, and so let me share on one more story, Asian Motors. So Asian Motors again, this is another stock which has done extremely well, but if you look at this trend, you're able to see that the profit has been declining after 2019 onwards. So you're able to find that the last 3 years, the stock hasn't moved much. So the last 3 years, the stock is more or less at the same levels. So almost at the same levels, if you're able to see this one. So ultimately, if you're looking at growth stocks, we need to bet on the earnings. If you're looking at the entry point is very important. More than that, if you are able to find a growth stock, you need to find what are the triggers for the future growth which is happening. So these are some things which we can focus on at the current situation. What I will do is like I'll keep you updated on further developments in terms of this one. So in terms of like posts in the group. So anything which you can just ping it on the link and you can communicate. So we'll catch up again sometime soon. Until then, see you everyone. Bye bye. I hope today's session added a value. We'll catch up pretty soon, to be after a couple of weeks time. Thank you everyone. Bye bye.